Every financial decision you have ever made, your rent, your savings target, your mortgage application, was built on a number that was never real. Hey everyone, I'm Prahlad Kumar, an MBA and PhD in economics. I've spent years studying how small behavioral shifts quietly shape massive wealth gaps. And here's the truth most people miss. It's not big, dramatic decisions that change your financial future. It's tiny, consistent habits that compound over time. Behavioral economics has proven this again and again. Systems beat motivation every single time. So today, I'm going to show you the exact framework. And in this video, I am going to show you 3 specific things. First, there is one deduction, legal, universal, and deliberately invisible, that costs the average U.S. worker more than their entire annual grocery bill. It does not appear on any offer letter. It does not appear in any salary comparison tool. I will show you exactly what it is. Second, every government on earth publishes your tax rate. Not one of them publishes the number that actually tells you what your labor is worth. I will show you how to calculate yours in under 4 minutes and why it changes everything. Third, if you earn in Naira, rupees, or Hayas, the salary illusion operates at 2 levels simultaneously. Most financial channels only explain the first. I will show you the second, the one quietly erasing decades of wealth building for middle-class earners across Nigeria, India, and Brazil. Stay with me. This one is going to change how you see every number on every payslip you receive for the rest of your life. Let me start with a moment almost every working adult recognizes. The job offer arrives. The number at the top reads $60,000. Something specific happens in the brain at that moment. Psychologists call it anchoring. Tversky and Kahneman identified it in 1974. It is the documented tendency to fix on the first number encountered and build every subsequent judgment around it. That $60,000 becomes your financial identity. Your rent calculation starts from it. Your savings target starts from it. Your sense of whether you are doing well financially starts from it. And it is wrong. Not slightly wrong. Structurally, systematically, institutionally wrong. Here is what actually happens to that $60,000. The first paycheck arrives. Federal income tax takes its share. Social Security takes 6.2%. Medicare takes 1.45%. Before you see a single dollar, the Tax Foundation's 2024 data shows that a $60,000 U.S. earner retains approximately $44,000. That is a 26.7% deduction, and we have not started yet. Most people notice this gap once. They absorb it. The anchor holds. $60,000 still feels like $60,000. The brain does not naturally update the identity number downward. But the deductions do not stop there. Health insurance premiums arrive next. The Kaiser Family Foundation's 2023 Employer Health Benefits survey found that the average employee contributes $6,575 per year toward employer-sponsored family health coverage. Over $500 every single month. This number never appeared on the offer letter. It never appears in any salary comparison on LinkedIn, Indeed, or Glassdoor. It is framed as a benefit, a gift from your employer. It is actually a mandatory deduction from your real compensation that the entire industry has agreed, structurally, to make invisible. Add a modest 401k contribution, and the true take-home for that $60,000 earner lands at approximately $36,000 per year. 60 cents of every dollar earned. Now cross the Atlantic. Sophie and James Carter live in Bristol, United Kingdom. Sophie teaches secondary school. James works in marketing. Their combined gross income is £65,000. They have spent 18 months planning a property purchase. Every conversation starts from £65,000, the number that defines their identity as a professional couple doing reasonably well. Their combined net take-home is £42,300. A gap of £22,700 exists between the number they plan from and the number that determines what they can actually afford. their combined student loan deductions, £1,980 per year, had become invisible. Not because they forgot about them, because the money left before they ever saw it. The Institute for Fiscal Studies confirmed in 2023 that a UK graduate earning £35,000 faces a combined marginal deduction rate of 41%. Income tax at 20%, national insurance at 12%, student loan repayment at 9%, on every pound earned above £27,295. 41%. That is the marginal rate officially reserved for higher-rate taxpayers. Applied to a salary, the government classifies as basic rate. Sophie and James had no idea. Now move to Mumbai. A 10 lakh rupees CTC package. The benchmark figure quoted in Indian graduate recruitment, the number announced at family dinners, the number that signals professional arrival, yields between 6 rupees and 20 paise and 6.8 lakh rupees in actual take-home. A 2022 survey of 4,200 employees by Team Lease Services confirmed the average gap between advertised CTC and enhanced salary sits at 28 to 38%. That gap comprises employer PF contributions counted inside CTC, gratuity provisions, medical insurance premiums, and variable pay components requiring performance targets. None of this appears in any job advertisement. No regulatory requirement in India mandates disclosure of enhanced salary. The information asymmetry is legal. It is deliberate. And it affects every salaried employee in the formal sector. In Nigeria, a formal sector worker earning 5 million gross faces a deduction stack of 30 to 34%, pay tax at applicable marginal rates, mandatory pension contribution at 8% of basic salary under the Pension Reform Act 2014, and National Housing Fund contribution at 2.5%. Net income approximately 3.5 million. PwC Nigeria's 2024 tax guide confirms these figures. Nigeria is frequently described as a low-tax economy. For formal sector employees, the mandatory deduction rate rivals several European nations. And in Brazil, a CLT formal sector worker earning 8,000 Brazilian reais per month gross retains approximately 5,600 Brazilian reais after INSS Social Security contributions, IRRF income tax withheld at source, and mandatory employer FGTS. Receita Federal, do Brazil's 2024 data, confirms a 30% deduction floor for mid-level formal earners. These gaps are not accidents, they are not oversights. They are the predictable output of a system where every institution involved in your employment relationship has a structural incentive to keep you anchored on the wrong number. And in the next section, I want to show you exactly how that system was built, and by whom. The cognitive bias at the center of all of this has a specific name. Money illusion. Irving Fisher first named it in 1928. Eldar Shafir, Peter Diamond, and Amos Tversky validated it empirically in a landmark study published in the Quarterly Journal of Economics in 1997. Here is the core finding. The human brain evaluates economic value in nominal terms, face value numbers, rather than in real purchasing power terms. It cannot naturally feel the difference between $60,000 in a 2% inflation environment and $60,000 in a 7% inflation environment. Both feel identical. They are not. The Shafir study produced a result that should permanently change how you think about every salary conversation you have ever had. Researchers gave participants a direct choice. Scenario A. Receive a 2% nominal pay raise in a year when inflation runs at 4%, a real pay cut of 2%. Scenario B. Receive a 0% raise in a year when inflation is also 0%, no real change at all. Scenario B is mathematically superior. Real income holds. Scenario A destroys real income by 2%. 75% of participants chose scenario A. 3 in 4 people will feel better about a raise that makes them poorer. This is not stupidity. This is a documented feature of human cognition that the entire employment and compensation system is built around. Here is the framework no employer, recruiter, or financial education channel gives you. Every earner actually has three completely different salary figures, and almost nobody knows all three. The first is nominal gross salary. This is the anchor. The number on the offer letter. The number quoted in job advertisements. The number you tell people at dinner. It is the number designed to serve the employer's recruitment interest, not your financial planning. The second is net take-home salary. This is what reaches your account after every mandatory deduction. It determines your month-to-month cash reality. Most people know this number approximately. Very few have calculated it precisely across every deduction category. The third is your real purchasing power salary. This is your net take-home adjusted for inflation over time. It is the only number that measures your actual standard of living trajectory. The International Labor Organization's Global Wage Report, 2022 to 2023, found that real wages across G20 economies declined 2.2% in 2022, the first real wage contraction since records began. Nominal wages grew 4 to 5% across those same economies. Every worker who received a raise that year and celebrated lost ground in real terms. Imagine 3 bars on a screen, each one shorter than the one before. Almost every financial plan ever built operates from the first bar. The number that determines your actual life is the third. And most people have never calculated it. Now I want to show you the 4 institutions that built the architecture keeping you anchored on the wrong number, and exactly why each of them benefits from your confusion. The first actor is your employer. In India, CTC framing is universal and deliberately structured to maximize the apparent size of the compensation package in a competitive recruitment market. Employers include their own PF contribution, gratuity provisions, and insurance premiums in the CTC figure they advertise, costs that represent the employer's expense, not the employee's income. No law requires them to disclose in-hand salary. The information asymmetry is legal, profitable, and entirely intentional. The second actor is your government. Withholding tax, Pay A in the UK and Nigeria, payroll tax withholding in the US, removes tax from your paycheck before you see it. This was not designed for administrative convenience alone. Milton Friedman helped architect the U.S. withholding system in 1943. He later acknowledged in his memoir that removing the money before the worker sees it dramatically reduces the psychological resistance to taxation. The man who designed the system that hides your tax burden told the world in writing that hiding your tax burden was the system's function. This is not a conspiracy. It is documented public policy history. The third actor is the health insurance industry in the United States. Bundling a mandatory cost into a benefits package transforms a salary reduction into a perceived gift. The Kaiser Family Foundation found that only 31% of U.S. employees correctly estimated their total annual health insurance contribution. 7 in 10 American workers are making financial decisions without accurately accounting for a cost that exceeds $500 per month for family coverage. The fourth actor is every major job platform on earth. LinkedIn, Indeed, Glassdoor. Each one displays gross salary by default. Not one displays net take-home. Not one displays purchasing power adjusted compensation. The platform's business model depends on job movement. Job movement is maximized when the numbers feel as large as possible. The incentive to show you the real number does not exist. The incentive to show you the largest number is structural and permanent. Now I want to introduce you to 3 people who discovered the real number and what happened when they did. Arjun Sharma graduated from a Tier 1 engineering college in Bengaluru in 2019. His offer letter read 14 lakh rupees CTC. He announced it to his family. He posted about it. He built his rent, his family remittances back to his parents in Pune, and his SIPE investment plan entirely around 14 lakh rupees. His actual in-hand salary was 8.9 lakh rupees. The gap, 5.1 lakh rupees, comprised his employer's PF contribution included in CTC, but locked in a fund he could not access. A gratuity provision representing the employer's future liability rather than his current income, a medical insurance premium he had never seen as a deduction, and variable pay that required performance targets he did not meet in year one. Arjun spent his first 3 months unable to understand why his savings were not materializing. He had done everything right. He had taken the high salary job. He had set up an SIP. He had calculated his budget. Every calculation was wrong, not because he made an arithmetic error, because every calculation started from a number his employer had designed to represent their cost, not his reality. When Arjun finally mapped his full gross to net waterfall, he described it as the most useful single piece of financial information he had ever received. He reduced his rent from 28,000 rupees to 18,000 rupees. He restructured his SIP until his first variable payout arrived. He rebuilt every financial plan from his in-hand salary. The anchor broke, and his financial life finally started making sense. Sophie and James Carter had been planning to buy a home in Bristol for 18 months. Their combined gross income of £65,000 gave them confidence. At 4.5 times household income, the standard affordability multiple used by UK mortgage lenders, they had been targeting a property valued at approximately £292,500. They felt comfortable. They felt on track. Their combined net take-home was £42,300. Sophie's after-tax, after national insurance, after student loan take-home was £21,900. James's was £20,400. Their combined student loan deductions of £1,980 per year had stopped registering as a conscious cost, the money left before it arrived, and the brain stopped counting money it never touched. The mortgage affordability, their real income supported, was approximately £190,000, not £292,500. They had spent 18 months emotionally and practically planning for a purchase their actual income could not support. The money illusion was not abstract for Sophie and James. It had consumed 18 months of their lives. Once they calculated their true combined net income, they redirected £400 per month into a lifetime ESA, capturing the 25% government bonus on every contribution, and revised their property timeline by 3 years. For the first time, they built every financial plan from the £42,300 that was real, not the £65,000 that felt real. Chisom Okafor works as a mid-level compliance officer at a multinational firm in Lagos. She earns 6.2 million gross per year, placing her in the top 8% of Nigerian formal sector earners. She knew she paid PAYE tax. She did not know her full deduction stack. When she mapped it for the first time, PAYE at her applicable marginal rate, 8% mandatory pension, 2.5% NHF contribution, her net annual income was 4.28 million. A 31% gap she had never calculated. But the more significant discovery was the currency layer. Between January and December 2023, the Naira depreciated over 67% against the US dollar. In dollar terms, Chisom's 6.2 million gross had fallen from $13,700 to $8,200. A 40% real compensation collapse. With no change on her payslip. No nominal reduction. No conversation with her employer. She had experienced a pay cut of nearly half in real terms, while her payslip showed exactly the same number it always had. This is the second level of the salary illusion that compounds the damage for every earner in a high inflation, currency depreciating economy. Chisom's response was specific and immediate. She negotiated a partial USD-denominated component into her compensation package. She began converting 15% of every monthly net salary into dollar-denominated assets on the day her salary arrived. And she recalculated her dollar-equivalent salary every 90 days, treating any decline above 10% as a real pay cut, requiring either a negotiation conversation or a portfolio rebalancing decision. Now let me give you the data that ties all of this together. The average U.S. worker earning $60,000 gross retains approximately $36,000 after income tax, Social Security, Medicare, average health insurance premiums, and a modest retirement contribution. That is 60 cents of every dollar earned. Tax Foundation, 2024. What this means for you: every savings target, every mortgage calculation, every retirement projection you have ever built using your gross salary is inflated by 40%. A UK graduate earning £35,000 faces a combined marginal deduction rate of 41% on every pound earned above £27,295. Institute for Fiscal Studies, 2023. What this means for you: if you are a UK graduate and you have never calculated your true marginal rate across income tax, national insurance, and student loan repayment simultaneously, you are operating every financial decision from a misunderstanding. Real wages across G20 economies fell 2.2% in 2022, despite nominal wage growth of 4 to 5%. International Labor Organization, Global Wage Report, 2022 to 2023. What this means for you: in the year that most employers delivered their largest nominal raises in a decade, every single worker in every G20 economy became poorer in real terms. In Shafir, Diamond, and Tversky's 1997 experiment, 75% of participants chose a nominal raise that made them mathematically poorer over a scenario that preserved their real income. Quarterly Journal of Economics, 1997. What this means for you: the salary negotiation you feel proudest of may be the one where you accepted a real pay cut dressed as a nominal win. A worker who builds their entire financial architecture from a gross salary baseline rather than a real net baseline will, on average, underestimate their required wealth-building capital by $320,000 over a 35-year career. Congressional Budget Office Income Projections and Tax Foundation Effective Rate Data, 2023. What this means for you: the cost of not making the calculation in this video is not $500 or $5,000. It is $320,000. Now let me give you 5 things that I want you to think about for the rest of today. First, the man who designed the U.S. payroll withholding system admitted it was psychological. Milton Friedman helped create tax withholding in 1943 as a wartime revenue measure. He later wrote that removing money before a worker sees it dramatically reduces psychological resistance to taxation. The system was designed to make your tax burden invisible. It succeeded. Almost no American has ever felt the full psychological weight of what they contribute, because the money is gone before they can feel its absence. Second, your raise last year was probably a pay cut. In 2022, average U.S. nominal wage growth was 5.1%. Inflation ran at 8%. Every worker who received a 5% raise celebrated and lost 3% of their real purchasing power. Every performance review conversation that year about whether the raise was adequate was conducted in a metric quite the money illusion made useless. Nominal salary growth in an inflationary environment is not a pay raise. It is a pay cut in a convincing disguise. Third, the tax system specifically penalizes you for earning income through work. Every additional dollar of salary you earn faces the highest marginal rate you qualify for. Every additional dollar of capital gain faces a structurally lower rate, often significantly lower. In the U.S., long-term capital gains rates top out at 20%, while income tax rates reach 37%. In the U.K., capital gains tax rates run 10 to 20% versus income tax rates of 20 to 45%. Working harder in isolation is one of the least tax-efficient strategies for building wealth available to a middle-class earner. No employer will ever tell you this. Because employers benefit when workers believe more labor is the primary answer to their financial situation. Fourth, The job platform showing you salaries is deliberately showing you the wrong number. LinkedIn, Indeed, and Glassdoor all display gross salary as the default. Not one displays net take-home. Not one has any financial incentive to show you the smaller, more accurate figure. The platform's revenue depends on job movement. Job movement is maximized when offers appear as large as possible. The information architecture of every major recruitment platform is designed around the employer's interest in attracting candidates, not the candidate's interest in financial clarity. Fifth, 3 in 4 people will accept a raise that makes them poorer if the nominal number is large enough. This is not a failure of intelligence. It is a feature of human cognition that every employer, every recruiter, and every compensation consultant understands. The entire corporate compensation industry is built on a bias your brain cannot override by willpower alone. The only override is calculation. Real numbers. Deliberately computed. Now here is exactly what to do about it, this week, this month, and at every income level. The first step requires zero capital and takes under 4 minutes. Calculate your real net income right now. Start with your gross salary. Subtract your income tax. Use the IRS withholding estimator if you are in the US, the HMRC tax calculator if you are in the UK, the Income Tax India portal if you are in India, or the PwC Nigeria Pay Guide for Nigerian formal sector rates. Subtract your mandatory social contributions, Social Security and Medicare in the US, National Insurance in the UK, PF and NHF contributions in Nigeria, INSS in Brazil. Subtract mandatory pension contributions. Subtract health insurance premiums in the US. Subtract student loan repayments where applicable. The number you arrive at is your real income. It is the only number that should govern every financial decision you make from this point forward. Write it down. Build everything else from it. The second step is to rebuild every existing financial plan from the net number. Your mortgage affordability, recalculate using net income, not gross. Your savings target, reset as a percentage of net income, not gross. Your emergency fund, recalculate in net monthly terms, 3 to 6 months of net income. Your retirement projections, rebuild the contribution base using real take-home. Every plan built from gross income is a plan built on a false foundation. Rebuild it today. The work takes one evening. The benefit compounds for decades. If you save $500 per month from your net income, here is exactly where to put it by market. In the US, open a Fidelity or Vanguard account and automate $200 per month into an S&P 500 index fund the day after payday. In the UK, open a Vanguard ISA and contribute £150 per month to the Global All Cap Index Fund. All growth inside an ISA is tax-free, which compounds your real return advantage directly. In India, set up a Zerodha Coin SIP into a Nifty 50 index fund, minimum 2,000 rupees per month, time to coincide with your salary credit date so the money moves before spending decisions capture it. In Nigeria, open a Bamboo or Chaka account and convert 20,000 per month into a dollar, denominated ETF. Immediately upon salary receipt, converting Naira to dollar assets is not speculation, it is inflation and currency protection executed as a systematic habit. If you save $2,000 per month from your net income, add these steps. In the U.S., maximize your health savings account contribution first. $4,150 for individuals, $8,300 for families in 2024. The HSA is the only account in the U.S. tax code that delivers a triple tax advantage. Contributions reduce taxable income, growth is tax-free, and withdrawals for qualified medical expenses face zero tax. No other vehicle available to a wage earner matches this. In the UK, max your EC allowance at £20,000 per year. Then consider SIP contributions. If you earn above £50,270, additional pension contributions at the higher rate generate 40% tax relief from HMRC. In India, contribute 50,000 rupees annually to NPS Tier 1 under Section 80 CCD 1B. This deduction sits entirely outside the standard Section 80C 1.5 lakh rupees limit, meaning it reduces your taxable income as a completely separate allowance. In Nigeria, voluntary additional pension contributions above the mandatory 8% are tax deductible under the Pension Reform Act 2014, and for currency protection, allocate a portion of surplus savings to Eurobond instruments denominated in US dollars. If you earn in Naira, rupees, or Haish, add this final step to your financial system permanently. Calculate your salary in dollar equivalent terms at the current exchange rate. Set a recurring calendar reminder every 90 days to recalculate. If the dollar equivalent of your salary has declined more than 10% without a nominal salary increase, that is a real pay cut. It requires an immediate response, either a compensation negotiation conversation with your employer, a rebalancing of your investment portfolio toward dollar-denominated or inflation-protected assets, or both. Chisholm did this. It changed everything. You can do it too. Let me close the 3 loops I opened at the start of this video. The hidden deduction that costs the average U.S. worker more than their annual grocery bill, and never appears on any offer letter, is the employer-sponsored health insurance premium, $6,575 per year for family coverage, over $500 per month. Invisible in every salary comparison, invisible in every job advertisement. Now you know it exists. Now you can calculate its exact impact on your real compensation. The number 3 governments do not want you to calculate is your real purchasing power wage. Net take-home, adjusted for inflation. It is always lower than your nominal gross salary. It is always lower than your after-tax take-home. And it is the only number that tells the truth about whether your standard of living is rising, holding, or silently falling. You can calculate it in 4 minutes using the framework I gave you in the solution section of this video. The second level of the salary illusion facing earners in Nigeria, India, and Brazil, the currency illusion, means your salary can fall 40% in real terms while your payslip stays completely unchanged. Chisholm discovered this. It cost her nothing to calculate it. Understanding it gave her the information she needed to protect everything she had built. Now you have that same information. Your employer knows the number that defines your financial reality. Your government knows it. Your bank knows it. The only person who has been making decisions without it is you. Calculate your real salary today. Build everything else from that number. Because the financial future you deserve can only be built on a foundation that is true. If this video changed how you see your salary, subscribe. Because next week, I'm going to show you exactly what to do with the real number you just calculated.